Hi, I'm Bob Wagner, Chief Investment Officer here at SRP, and thank you for joining us for the SRP Market Insights Q4 2025. Okay, every quarter we review what we call the headwinds and the tailwinds, and for the most part, the markets have been ignoring any of the headwinds. What I like to say is this market's been climbing a wall of worry. So, if you go down the headwinds, you've got the Russian-Ukrainian war continuing. You have potential overextension and reliance on the Magnificent Seven, rising federal debt, political uncertainty, tariffs, stretched consumer spending. There's a need for prudent fiscal discipline, and we have the tariff ruling coming up, and the possible uncertainty that's going to create. So there are headwinds out there, but the market's ignored them, and the tailwinds seem to be winning. We've got the fixed incomes providing a decent yield now. The expansive fiscal policy does support economic growth. We have elevated cash on the sidelines, and that's going to be important going forward because interest rates are starting to come down, and a lot of that money that's in the cash right now may be looking for a new home, likely going to be equities and fixed income. The newest administration is implementing supply side policies. Historically, those have been very stimulative for the economy and very good for the stock markets. There are serious efforts going towards getting the deficit under control. You got DOGE, the tariff revenues are coming in, tax revenues are coming in, regulatory relief, and onshoring initiative. All those can be both stimulative, and they can cause problems as well, as you know, with the tariffs. And likely oil prices are going to continue to decline. I'm saying that a day or so after there's been new threats towards the Russian oil supply. But I would imagine over the longer run, those are going to get resolved, and we're going to see the price of oil coming down as the U.S. production of oil goes higher. All right, one of the things that we find really interesting is how the markets have been defying the experts. The markets have adapted extremely well to this new tariff and policy regime. If you just simply look back, what were the headlines saying, and then compare them to what you're actually getting, it's really quite stark. Tariffs were going to drive inflation. Well, despite a weaker U.S. dollar, inflation has remained moderate. Now, I never bought into the tariff causing inflation argument, period, because talk to an economist, they're going to say in order to have sustained inflation, you're going to have sustained wage growth. Well, tariffs are a one-time price increase, and that one-time price increase doesn't necessarily put more money in your pocket. What it does is make some things more expensive so you can buy less of them, and so you might shift your thing, but it's not, there's no, taxes normally don't cause inflation. So I never really bought that argument to begin with. And so what you're seeing now is, you may get some price increases, but it's not going to be a sustained price increase, which is what inflation is. Tariffs could cause or trigger a recession. Well, we're seeing kind of the exact opposite, partially because of the AI boom. The economic growth has been resilient. Also, there's a quirk in the way that GDP's calculated. And so as net exports go down, your GDP goes higher. So the economic growth has been relatively resilient. And, if you look at something like GDP now from the Atlanta Fed, it looks like they're expecting some pretty solid growth going forward. China controls the rare earth supply, and that's come to the headlines recently. But if you take a look, you can see that the U.S. is rapidly developing its own rare earth supply and trying to find new sources such as Australia. Tax cuts lead to higher deficits and rising interest rates. Well, we're seeing interest rates falling. And the tax cuts don't necessarily cause a higher deficit. Spending causes the higher deficit. So we're basically just going to have to sit back and see how does, do the new tax revenues help with the budget or not? Will the tax cuts result in lower revenues to the government? That's going to be to be determined. Federal jobs and spending cuts could cause a recession. We also have the government shutdown now. What's going on is we're shifting labor from the public into the private sector, and that's typically good for the economy. Not to minimize the impact of a government shutdown. Hopefully they'll get that resolved relatively quickly. But for the most part, the markets seem to be accepting what's going on and moving forward. Immigration policy may result in labor shortage. Wage growth has been solid. Unemployment low. which is what you'd expect if you take away part of the labor force, and economic growth resilient, especially when adjusted for net exports. So, there are disruptions with the immigration policy. However, at least according to the market, it seems to be digesting it pretty well. Bond rates could soar, causing market collapse. That didn't happen. Interest rates have remained relatively stable, and the stock market is at record highs. And the front end's coming down. The back end has been stubbornly high and kind of resistant to coming down, but bringing down the front end is pretty good, and it's been helping support the economy and support the U.S. markets. All right, this is one of the biggest stories out there right now. The Federal Reserve, even in the wake of all the fear about tariffs causing inflation, has started to cut interest rates. We've already had one rate cut, and as you can see from the schedule right here, by the time we get to July next year, we're going to be probably a full 100 basis points or 1% lower than we are. The next meeting here in October, expect a rate cut. Then we get out to December, expect a rate cut. Then we get out here to March of next year, you're going to expect a rate cut. And then when we get to July, you're going to expect another rate cut. So as you can see, over the next year, we're probably going to get about full 100 basis points lower. Over here, you can kind of see the probabilities of where we're headed. And as you can see, interest rates are headed lower. Now, this is the front end of the yield curve, the very short end, the overnight rates that the Federal Reserve deals with. The back end of the yield curve, the longer maturity bonds have been relatively stubborn, whereas the front end's coming down, the back end's really not coming down that much. Eventually, if they start to get the deficit under control, that back end is going to come down. Now, why is that significant? You start bringing the back end down, you bring down mortgages. You bring down mortgages, you're going to free up a lot of housing inventory as people finally are willing to sell their homes because they are comfortable refinancing, right? Do that, that helps bring down the whole housing part of the CPI, and that would allow for even lower interest rates. So this lowering of the interest rates is likely to set off a chain of events that should be relatively positive for the market. The other thing is, as you bring down the front end of the yield curve, the Treasury can then go in, borrow on the short end, and buy the longer term bonds and start to flatten it as well. So there's techniques that the Treasury can use to use the lower front end to help bring down the back end. And if you bring down the back end, it does a whole lot to stimulating the economy and the markets. All right, this is one of the most interesting situations, not only of the last quarter or the current market environment, but probably within my entire career. This is one of those interesting situations where you have an extreme macro policy that's going to be a binary event with a relatively known endpoint. This is what's going on is President Trump has implemented a large number of tariffs. Well, the problem is there's a court challenge to those. And right now, there's a 70 to 80% likelihood, according to the experts, that the Supreme Court is going to overrule or decide that President Trump's tariffs are unconstitutional. And if you read Article 1, Section 8, typically taxes are given, the power of taxing is given to the Congress. So they might have a case there. And so the good news is the experts predict a decision by the year end of 2025 or early 2026. So that's what I like about this is this probably is going to create some uncertainty, but there's a definitive end point. We're going to know when it's going to happen. It's kind of like an FDA drug approval. You either get FDA drug approval or not, but the market can then immediately adjust and go on, right? Well, that's what the experts are saying. If we go down to what the markets are saying, and we're going to use Polymarket as a source here, there's a 43% chance that the Supreme Court's going to rule in favor of President Trump. That means there's a 57% chance they're going to overturn it. And so this is what kind of surprises me, because that's essentially a flip of a coin to me. Sometimes this thing was 50-50. And that type of an event strikes me as that should be causing some uncertainty, but the markets continue to go higher. So there could be a scenario where the markets like the tariffs, but if you reverse them, they might like it even more, right? So this may be a win-win situation where the market may just go higher with the tariffs in place, or accelerate if they're reversed, and we may not get a correction due to the uncertainty. The other question that you have to ask here is, will the court force Trump to return refund the tariffs? Now, that I would imagine would cause some serious problems, and the market's giving an 8% chance of that. Now, why is that important? Because let's say they do rule President Trump's tariffs as unconstitutional. Well, if he has to return all those tax revenues have already been baked into bringing the deficit down and bringing down the back end. What would probably happen is if that all gets reversed, you're going to probably see the back end no longer going lower, but actually going higher. And I would imagine that would really shock the markets. But once again, the nice thing is we're going to know relatively soon, because the decision's supposedly going to be made before the end of this year or very early into 2026. But it's definitely something to watch. All right, here's one of the other interesting things going on right now. And we wanted to use this chart to kind of show you the incredible dynamic nature of the U.S. economy. If you go back to 1985, you can see they're basically one technology company. It was IBM, right? This was before the real emergence of the PC. The PC was just getting introduced around this era, right? You go forward 10 years, the PC had been introduced and IBM had shrunk, right? And so you can see what happened here. The introduction of the PC pretty much killed IBM. But you can see there's basically no technology companies here during this era. But what's significant about 95? Well, 95, what happened? You introduced Windows 95. You had the Pentium chip back then. You had the dial-up modem, and you introduced the internet. You unleashed the internet on the free market system. And so that changed the world right there. So going forward, you go another 10 years, and what happens? Now you're suddenly seeing Microsoft pops up, right? IBM continues to be there, right? But you can start to see, now you're starting to see the new growth of Microsoft. Okay, what happened right after 2005? You introduced the iPhone, right? So you go forward another 10 years, and now you see Apple. Now you're seeing Microsoft. You're starting to see the new technology companies coming on, right? Then you go forward another 10 years, and what is it? It's almost all technology. You got Apple, NVIDIA, Microsoft, Amazon, Alphabet, which is Google, Meta, Tesla, Broadcom. Then you've got JP Morgan and Berkshire Hathaway. But you can see there's a huge dependence upon technology now. Going back in history, you can see this can change. However, I would argue this lineup is probably going to be a little bit more resistant than the past, simply because we've gotten ourselves into an AI war. Looking forward, you're going to have to spend a lot of money to get ahead of there. And the way I would describe where we are in the AI cycle is, I would say we're back in the dial-up era. If you remember back in 95, we were in the dial-up era. You had AOL, but you knew things were so slow they were going to have to speed things up. So you went from dial-up to cable to fiber optics to wireless to satellite, right? Well, we're in the dial-up era for AI. You know, if you pick up a phone and there's a pause, you know that's AI, probably. And so what they have to work on the latency. They've got a lot of things to improve to get everything faster, get it more accurate. And so we're just at the tip of this iceberg to see what's going to happen going forward. So, and if you just take a look at these companies compared back to 2000, back in 2000, everything was new. They were all IPOs. They would sell their IPO. They would get their money, and then you would follow things on basically what was called cash burn basis. Let's say you raised $100 million in your IPO. You spent $10 million a month. That gave you 10 months to come up with a viable product. A lot of those IPO companies wasted that money. Pets.com, they took their money and bought a commercial on the Super Bowl, right? So today, however, you're dealing with some of the best capitalized companies in the world, and they're well capitalized, and we're just starting a whole new technological phase called AI. So it's going to be really interesting to see how this unfolds and whether or not these can remain more resilient than the leaders of the past. All right, well, now that we've covered all these different topics, now we have to say, well, what do we do with this information, right? So what we covered? We covered the falling rates, a steepening yield curve, and large cash holdings on the sideline. Well, what's that going to do? That's probably going to favor a relatively strong both equity and bond markets. Especially if the back end of the yield curve comes down. I would imagine that's going to be that'll be one of the best catalysts you can imagine to drive the equity markets higher. If the back end comes down for reasons other than a recession. If the back end comes down because of a recession, all bets are off. Equities will probably be hurt, but Treasury bonds should do well. Weakening dollar. It's definitely good for gold. It's been driving gold through the roof. Anything that's priced in dollars on an international market, which should go higher as prices go down. With the caveat is, look what's going on with oil, however. The dollar's been going down as well as the oil price. That means the drop in oil price has actually been magnified, and it's been actually strong, higher. It would be lower right now in the U.S. if it wasn't for a weaker dollar. So that's really one of the interesting stories about the oil market, is that oil market's pretty weak. Now, the weaker dollar also will tend to favor international over domestics. That's why you saw the internationals do well last year. That dollar came down. The dollar coming down alone props up the value of international stocks. However, there's also a benefit of a weaker dollar to U.S. companies, because U.S. companies that have international sales, those sales translate back into more dollars when they come back. So our international companies are benefit from a weaker dollar as well. The tariff issue, as we covered, that's going to warrant some caution, but the market seems to already know what the risks are, and it seems to be marching higher. So it's going to be very fascinating, at least for me, what happens later on this year on what the Supreme Court rules. And I'll be watching particularly on how the markets respond. I mean, there's a couple of arguments like we covered. The markets may like the tariffs, but they may like it even more without the tariffs. So we may not see a correction, but it's certainly going to be something worth watching. Earnings and AI trend favors growth over value. The growth is going to be largely focused towards earnings. Some of the value you may see, there's going to be a lot of money spent on developing energy. So you may see some oil services and companies like that doing well. But right now, if you look forward, the major trend is definitely AI. That you can just take a look at the composition of the indices to see where the money and the earnings are. Earnings and AI trend tend to favor large caps over the small caps. Small caps can't go write a $50 billion check to write a server farm. There's advantages to being big in this environment. Though lower rates could benefit small caps, so AI is going to favor large caps. Lower interest rates are probably going to benefit small cap over large caps. So you may see periods where small caps do outperform large caps and vice versa. But it's, that environment of lowering interest rates and a strong economic argument for AI can give you a strong argument for both small and large cap domestic stocks. The rising deficit may lead to crowding out and slower economic growth. That's true if the back end remains high, driven by a continued need for government borrowing. However, if the government does what it's been talking about doing, and that means get the deficit under control, and the back end starts to come down, that fear is going to go away. Crowding out, of course, is when the government borrows so much money that it drives up interest rates, and it crowds out the private sector from borrowing that money, that's slowing economic growth. I would argue probably what you're going to see is the exact opposite of that. You're going to see the back end coming down. The Treasury markets, the Treasury can do certain things as the front end comes down. It can borrow at the front end and buy at the back end, lowering bonds there as well. And so there's things that they can do to bring that back end down. But the most important thing, of course, is get the federal deficit under control. If you do that, the back end is going to come down for all the good, right reasons. And then you're going to see a really nice economy and probably rally in the bull markets. And so if the back end of the yield curve comes down for any reason other than a recession, that's going to be probably really good news. Now, all this goes out the window if the back end's coming down because of a recession. If we do fall into a recession, the back end will come down. Treasury should go higher, but equity markets should go lower. So, but bottom line is we're entering some pretty interesting periods. So pay attention and keep an eye on what happens with the Supreme Court. Thanks for watching.